This is Saturday, January 31st, 2026. My name is William Lee, and what I'm about to tell you is the most important information I have ever shared in my 23 years of analyzing precious metals markets. Yesterday, Friday, January 30th, 2026, was one of the most violent trading days in the history of silver and gold. Silver crashed from $121 to $95 in a matter of hours. $26 erased. Gold collapsed from $5,600 to $4,950. $650 wiped off the map. If you are watching this and you are panicking right now, I need you to stop. I need you to take a breath. I need you to watch this entire presentation because what I am about to show you does not make any sense. The numbers do not add up. The story the market is telling you is not the real story. And if you do not understand what is actually happening behind the curtain, you are going to make decisions that cost you everything you have worked for. This is not entertainment. This is not speculation. This is a warning from someone who has seen exactly this pattern before and knows exactly where it leads. Silver crashed 22% in a single week, one of the biggest weekly collapses in the history of the precious metals market. And yet right now, at this very moment, you cannot buy physical silver. Let me repeat that because I need it to penetrate through all the noise and all the fear and all the confusion clouding your judgment right now. The price is crashing, but you cannot buy the product. The Perth Mint in Australia has suspended sales. The United States Mint has suspended sales. The Royal Mint in the United Kingdom is out of stock. Dealers across India are defaulting on deliveries. Costco, the wholesale retailer where Americans buy toilet paper and rotisserie chicken, has implemented purchase limits on silver bullion. Does that make sense to you? Does that sound like a real market operating according to genuine supply and demand? In any normal market, when price crashes, supply increases. Sellers come out of the woodwork. Product floods the market. Inventory piles up. That is how markets have functioned since the beginning of human commerce. But that is not what is happening here. Here, the price is crashing while supply is vanishing. The price is going down while the entire world is running out. Something is very wrong. Something is broken. And by the time you finish reading what I have to share with you today, you will understand exactly what it is. Let me tell you why yesterday's crash is not what it appears to be. Earlier this week, before everything collapsed, I told anyone who would listen that 117s was a crucial zone for silver. I explained why a crash was likely coming. I showed historical patterns going back 30 years that predicted exactly this kind of move. At that time, everyone was bullish. Everyone was celebrating the gains. Everyone thought silver was going straight to $150 without stopping. And now here we are. Silver crashed from $121 to $95. But here is what I did not expect. I did not expect that while silver was crashing, the physical market would completely break down. I did not expect mints around the world to suspend sales simultaneously. I did not expect Indian dealers to default on deliveries. I did not expect a complete and total disconnect between paper prices and physical reality. And that disconnect is what we need to talk about because understanding it could save you from making the biggest mistake of your financial life. Let me explain how the silver market actually works because most people do not understand this. And that misunderstanding is costing them money right now as I speak. There are two silver markets, not one. Two completely separate markets that are supposed to be connected but are telling completely different stories at this moment. The first market is the paper market. This is COMEX. This is where futures contracts, derivatives, options, and digital silver trade. This is where hedge funds, banks, and institutions trade billions of dollars worth of silver every single day. But here is what you absolutely must understand. They are not trading real silver. They are trading paper promises, contracts that say someone will deliver silver at some point in the future. Most of these contracts never result in actual physical delivery. They are just bets, casino chips, financial instruments with no physical metal behind them. The paper market is like a giant poker game where billions of dollars change hands, but at the end of the night, most players never actually see or touch any actual silver. The second market is the physical market. This is where actual silver trades, real metal, coins you can hold in your hand, bars you can stack in a safe, the tangible substance that exists in the real world that has weight and density and atomic properties that cannot be created with a keystroke. Now here is the critical point that determines everything. These two markets are supposed to be connected. The paper price is supposed to reflect what physical silver is actually worth in the real world. Arbitrage is supposed to keep them aligned. If paper gets too cheap compared to physical, traders are supposed to buy paper and sell physical until the prices converge. If physical gets too cheap compared to paper, the opposite happens. That is how it is supposed to work. But right now, at this very moment, these two markets are completely disconnected. The link is broken. The arbitrage mechanism has failed. The paper market says silver is $95 per ounce. The physical market says you cannot have any at any price. One of these is lying to you. Which one do you believe? The number on the computer screen or the empty shelves at every major mint on the planet? Let me show you the evidence. I have documentation, I have data, I have facts that cannot be disputed by anyone arguing that markets are functioning normally. The Perth Mint in Australia, one of the largest and most respected mints in the entire world. They have been producing gold and silver bullion for over a century. Governments trust them, central banks trust them, institutional investors trust them, individual investors around the world trust them. On Thursday morning, before the crash even happened, when silver was still trading near $117 and everything looked perfectly fine on the surface, they sent a notice to their wholesale distributors. I have seen this notice. I have read every word of it. Here is what it says. Due to the increasing worldwide demand for silver bullion products, we have a large backlog of orders for the 2026 Kangaroo 1-ounce silver bullion coin. As a result of this, we have decided to pause taking wholesale orders for this coin from today until 23rd February to clear the back orders. Read that again. Let every single word sink into your consciousness. Increasing worldwide demand, not decreasing, increasing. Large backlog of orders, not surplus inventory sitting around collecting dust. Backlog, pause taking orders, not discount sale to move excess product. Pause until February 23rd. That is almost a full month of no new wholesale orders for one of the most popular silver bullion products in the world. This notice was sent when silver was still at $107 before the crash, when everything looked fine on the surface. When mainstream financial media was telling you everything was normal, they are also implementing monthly allocations to ensure all regions receive stock. Monthly allocations, that is rationing language. That is what governments do during wartime when essential supplies run short. That is what you do when you do not have enough product to meet demand and you have to decide who gets what and who goes without. This is not a company having a bad day. This is not a temporary website glitch. This is not a minor supply chain hiccup. This is the Australian government mint, one of the most reputable mints on earth, telling the global market that they cannot keep up with demand for physical silver. Australia is one of the largest silver-producing nations on the planet. They mine massive quantities of silver every year, and their own official government mint cannot get enough silver to meet customer orders. And then the crash happened. Silver dropped from $117 to $95. A $22 discount in a matter of days. Now think about this logically. Use basic common sense. If the Perth Mint was already at breaking point when silver was at 117, what do you think happened when silver crashed to $95? Every smart investor in the world just saw a 22% discount on an asset that mints cannot even keep in stock. What do you think they did? They bought. They bought everything they could find. They cleaned out every available ounce. The crash did not reduce demand. It created a tsunami of new demand. It was like announcing a flash sale on the last television sets in a city preparing for a hurricane. People did not walk away. They sprinted to buy. Now let me show you the United States Mint, because the situation there is even more alarming. The U.S. Mint has suspended all sales of silver numismatic products. Their website shows products as temporarily unavailable across nearly every silver category. When you call their customer service line, they tell you they are updating prices. But here's what actually happened behind the scenes. Silver prices moved so fast and so violently that the Mint could not keep up. They were selling silver eagles at $91 when the spot price was moving above $90. They were losing money on every single sale, so they stopped. They suspended everything. They pulled products from their website, and when products came back online after the repricing, the price had jumped from $91 to $169, an 86% price increase overnight. The 2026 American Silver Eagle that was supposed to release in January has been delayed to late February. Subscriptions are already sold out. This is the official government mint of the United States of America, the most powerful economy in the history of human civilization, telling you they cannot sell you silver at the old prices and do not have enough inventory to meet demand at the new prices. But it gets worse. Let me tell you about India, because what is happening there should terrify anyone paying attention. India is one of the largest silver markets in the world. Indians have been accumulating precious metals for thousands of years. It is embedded in their culture. It is part of their religious traditions. It is how families store wealth across generations. And right now, dealers across India are not just running low on inventory, they are defaulting on deliveries. That means they are taking orders, accepting payment, and then failing to deliver the product. People are paying for silver and not receiving it. The headlines coming out of India right now are shocking. Not even a sliver of silver available. Amazon India sellers are defaulting on silver deliveries. People are posting screenshots of their orders being canceled after payment was already accepted. This is not a supply issue anymore. This is a breakdown of the physical delivery system. The mechanism that is supposed to connect buyers with sellers is failing. Trust is evaporating, and it gets even worse. The Royal Mint in Britain, the official mint of the United Kingdom, one of the oldest mints in the entire world. They have been producing coins for over 1,000 years, longer than most nations have existed, out of stock on silver bars, even 1 kilogram bars, the most basic and common format that constitutes the backbone of the retail silver market. Gone, unavailable. When major sovereign mints across multiple continents, Perth in Australia, the US Mint in America, the Royal Mint in Britain, are all experiencing the same critical issues at the same time, that is not coincidence. That is not bad luck. That is not a temporary glitch. That is a systemic crisis unfolding in real time. And if you think that is bad, wait until you hear what Costco is doing. Yes, Costco, the wholesale retailer, the place where Americans buy toilet paper in bulk and rotisserie chicken for $5. They sell silver bullion. They have for years. It has become one of the most popular retail channels for precious metals in America. And now they have implemented purchase limits. You cannot just buy as much as you want anymore. They are limiting transaction sizes. They are rationing. Costco is rationing silver. Let that sink in for a moment. A retail store whose entire business model is built on selling things in bulk, in massive quantities at wholesale prices, is now limiting how much silver customers can purchase. Why would they do that? There is only one reason. Because demand is overwhelming supply. They have to ration what they have so more customers can get at least something rather than a few customers buying everything. And here's where it gets truly alarming. Here is the part that should genuinely scare you. Let me show you what is happening in China, because while Americans are panicking and selling paper contracts, the Chinese are doing something very different. I have the Shanghai Futures Exchange data from yesterday, January 30th. Fresh data, real numbers, verifiable facts. The Shanghai Futures Exchange silver vaults currently hold 455 metric tons of silver. That is 14.6 million ounces. Sounds like a lot, right? It is not. And here's the part that made my jaw drop when I first saw the numbers. In one single day, one single trading day, 26.94 metric tons of silver were removed from the Shanghai vaults, almost 27 tons in 24 hours. I need you to understand how insane that number is. 27 tons is approximately 870,000 ounces of physical silver removed from a single exchange in a single day. At this drain rate, the Shanghai vaults could be completely empty in less than 3 weeks. For context, annual global silver demand is over 1 billion ounces. The Shanghai vaults now hold just 14.6 million ounces. That is barely 1.5% of annual demand. That is nothing. That is a rounding error. That is a buffer that could disappear in a matter of days if the current pace continues. And nobody in mainstream financial media is talking about this. Nobody. The financial networks are showing you charts of the price crash and interviewing analysts who tell you silver was overbought and due for a correction. Not one of them is telling you about the vault drain in Shanghai. Not one of them is telling you about the Perth Mint suspension. Not one of them is connecting the dots that tell the real story. Now here's what makes this truly frightening. China has already restricted silver exports. They announced this policy change effective January 1st, 2026. They have classified silver as a strategic national security asset. They are treating silver the same way they treat rare earth minerals, the same way they treat materials essential for weapon systems and artificial intelligence infrastructure. Think about what China is doing right now. They are restricting exports. No silver leaves China. They cannot send it to the rest of the world even if they wanted to. And simultaneously, they are draining their own domestic exchange vaults. They are taking physical delivery. They are moving metal from public warehouses to private storage. They are accumulating every ounce they can get their hands on. What does that tell you? It tells you that China knows something we do not. They know what is coming. They are hoarding physical silver while the paper market crashes. They are preparing for something. While American banks are selling paper contracts and crashing the price on screens, China is taking physical delivery of every ounce available. One side is selling paper, the other side is hoarding metal. Which side do you think knows what silver is really worth? Now let me tell you who is doing the selling, because this is perhaps the most important part of everything I have to share with you today. Pay very close attention to what I am about to explain. Nearly all of the selling this week in silver has occurred during United States market hours, not Asian hours when Shanghai and Hong Kong are trading, not European hours when London is active, United States market hours, when New York wakes up and COMEX opens. The pattern is unmistakable when you look at the data hour by hour. When New York opens, silver dumps, red candles, aggressive selling, price collapses. When New York closes, silver stabilizes. Sometimes it even rises during Asian hours as Eastern buyers accumulate. Then New York opens again the next morning, and the selling resumes immediately. This pattern has repeated every single day this week. It is not random, it is coordinated. The United States sells and dumps digital derivatives and paper promises. The rest of the world buys and accumulates physical metal. I need you to really think about what I just explained. American banks are selling something they do not have. They are creating digital silver out of nothing. They are pressing buttons on keyboards and moving numbers on computer screens. Meanwhile, people in Asia and the Middle East are loading physical silver bars onto trucks. They are taking delivery, they are draining vaults, they are removing real metal from the system and putting it into private storage where it cannot be lent, leased, or rehypothecated. One side is playing a video game with fictional silver, the other side is taking home the actual prize. American banks and institutions are flooding the paper market with sell orders, driving the price down. They are selling contracts for silver they do not possess and never intend to deliver. They are creating artificial supply out of thin air with a few keystrokes. Meanwhile, Asian buyers in China, Japan, and India are buying real physical metal. Middle Eastern buyers in Dubai and the UAE are buying real physical metal. They are taking delivery. They are draining vaults. They are removing silver from the system permanently. The paper price goes down. The physical metal disappears. This dynamic is not new. This has been the pattern for as long as I have been watching these markets. For years. For decades. The West sells paper. The East buys physical. But right now it is happening more aggressively and more blatantly than ever before. The disconnect between paper selling and physical buying has never been this extreme in my experience. This is not a free market. This is a rigged game, and if you do not understand how the game works, you will be the victim of it. You will sell your physical metal at the bottom because the paper price scared you, and someone in Shanghai or Dubai will happily take it off your hands at a massive discount to what it is actually worth. Do not be the victim. Be the one who understands. Let me show you the lease rates because this data confirms everything I am telling you. Lease rates are what it costs to borrow physical silver. In normal markets, when silver is plentiful and easily available, lease rates hover near zero, around 0.3 to 0.5%, essentially free. Right now, silver lease rates have exploded higher. Some reports show rates of 8%. Others show rates as high as 39%. 39% annualized just to borrow silver temporarily. That is a panic signal. That is an alarm bell ringing as loud as it can possibly ring. That means physical silver is so scarce that holders are demanding massive premiums just to temporarily lend it out and risk not getting it back. When lease rates spike like this, it means the physical market is broken. It means there is not enough real metal to go around. It means the people who actually have silver are terrified of letting it out of their sight because they do not trust they will ever see it again. Now let me connect all of this together for you because the individual data points only make sense when you see the complete picture. What we are witnessing is a complete breakdown of the paper-silver pricing mechanism. For decades, the price of silver has been set by paper trading. Banks trade hundreds of millions of ounces of paper silver every single day. The actual physical market is tiny by comparison. Maybe 1 or 2% of the volume traded is actual metal changing hands. This disparity has allowed the paper price to be manipulated, suppressed, and controlled. A relatively small amount of concentrated selling can move the paper price dramatically because the paper market has become completely detached from physical reality. But now something has changed. Physical demand has overwhelmed the system. Mints cannot keep up with orders. Vaults are being drained at unprecedented rates. Dealers are defaulting on deliveries. Lease rates are exploding to panic levels. The paper market says $95 per ounce. The physical market says there is no silver available at any price. Eventually, one of these realities has to give way to the other. Either the paper price rises dramatically to reflect physical reality, or the physical market completely breaks down and stops functioning. I believe we are approaching that breaking point faster than most people realize. The divergence cannot be sustained indefinitely. Something has to snap. Now let me tell you what this means for you because understanding the situation is completely useless if you do not know how to act on the information. I am going to be very direct with you. No sugarcoating, no hedging, no maybe this or maybe that. If you are holding physical silver, do not panic. I repeat emphatically, do not panic. Do not let the paper price scare you into selling your metal. Look at the facts I have presented. Mints are suspending sales because they cannot meet demand. Dealers are defaulting on deliveries because they have no inventory. China is hoarding every ounce available. Vaults are draining at record rates. Lease rates are exploding to levels that indicate acute shortage. And you are sitting there holding the one thing the entire world is scrambling to acquire. The paper price is noise. It is manipulation. It is a magic trick designed to separate you from your metal. Your physical silver is worth what someone will actually pay for it in the real world. Right now, that is way more than $95. Hold your metal. Do not be fooled by numbers on a screen. If you are holding paper silver, ETFs, futures contracts, mining shares, you need to ask yourself one critical question. If everyone demanded physical delivery tomorrow, could your counterparty actually deliver? The answer is almost certainly no. There is not enough metal in the system to satisfy all the paper claims. You do not own silver. You own a promise. And promises break, especially during times of crisis when they are needed most. Paper silver may have been a reasonable proxy for physical exposure during calm markets, but we are not in calm markets anymore. We are in a systemic crisis where the rules are changing by the hour. If you are looking to buy physical silver, good luck. I say that genuinely because finding available inventory at reasonable prices has become extremely difficult. Physical premiums are exploding around the world. Japan is paying 60% over the paper spot price. Dubai is paying 40% over spot. The paper price says $95. The real world price, if you can actually find metal to purchase, is $120, $130, possibly higher. If you can find physical silver at reasonable premiums, consider yourself lucky. That inventory will not last. It will be gone within hours of becoming available. And here is the paradox that should blow your mind if you think about it carefully. The lower the paper price crashes, the faster physical silver disappears. Lower paper prices create more buying demand because everyone sees a discount. More buying demand drains supply faster. The crash is making the shortage worse, not better. Every downward tick on the paper price accelerates the drain of physical inventory. The manipulation is feeding on itself and creating the conditions for its own destruction. Now let me address something important because I know some people watching this will be skeptical. Some people will say this is conspiracy theory. They will say the silver market is functioning normally. They will say mints are just having temporary issues that will resolve themselves next week. To those people, I say, look at the evidence I have presented. Look at the data. Perth Mint suspended wholesale orders until late February. US Mint suspended sales and repriced products 86% higher overnight. Royal Mint UK completely out of stock on basic products. Indian dealers defaulting on deliveries and canceling paid orders. Costco implementing purchase limits on bullion. Shanghai vaults drained of 27 tons in a single day. Lease rates hitting 39%. This is not one mint having a bad week. This is every major source of physical silver on the planet experiencing unprecedented stress at exactly the same time. That is not conspiracy. That is data. That is documented fact. That is observable reality. Now let me talk about timing, because the timing of yesterday's crash was not accidental. Yesterday was Friday, January 30th, the last trading day of January, the last trading day of the week. This timing is not coincidence. Big moves often happen on Fridays, especially end-of-month Fridays. Options expire, futures contracts settle, traders square positions, window dressing occurs. The timing of this crash was calculated. It was deliberate. January 2026 was the biggest month for silver in decades. 65% gains at the peak. Record-breaking moves that captured headlines around the world. Mainstream attention was finally turning to silver. New investors were flooding in, and then on the very last trading day of January, they crashed it. They sent a message. They shook out weak hands. They created fear and panic. This is how the game has always been played. This is how wealth is transferred from emotional retail traders to patient institutional accumulators. Your fear creates their buying opportunity. Your panic selling becomes their accumulation phase. Let me show you the bigger picture, because what happened yesterday did not start yesterday. This has been building for years, and if you do not understand the context, you will not understand why I believe this situation is about to get much more serious. Silver has been in a supply deficit for 5 consecutive years, 5 years of demand exceeding supply. Since 2021, global silver demand has exceeded global silver supply every single year without exception. Let me break down the mathematics, because numbers do not lie. Every year, the world mines approximately 835 million ounces of silver. That is total global mine production from every silver mine on the planet. But every year, the world consumes over 1 billion ounces of silver. Industrial demand for solar panels is exploding as the world transitions to renewable energy. Industrial demand for electronics is growing as technology penetrates every aspect of modern life. Industrial demand for electric vehicles is surging as the automotive industry transforms. Medical devices require silver for its antimicrobial properties. Countless other applications consume silver in ways most people never consider. Investment demand for coins, bars, and ETFs has increased dramatically as people lose faith in paper currencies. Jewelry and silverware demand remains steady, particularly in traditional silver-consuming cultures. Total demand exceeds total mine supply by hundreds of millions of ounces every single year. The cumulative deficit over these 5 years now exceeds 800 million ounces. Think about that number, 800 million ounces of demand that exceeded supply. Where does that extra silver come from? It has to come from somewhere. The answer is above-ground stockpiles, vaults, reserves, recycling, inventory that was built up over previous decades when supply exceeded demand. Think of it like a bathtub. New mine supply is the water coming in from the faucet. Demand is the water draining out through the drain. For 5 consecutive years, more water has been draining out than coming in. The bathtub is emptying. Those stockpiles that once seemed enormous are now running dangerously low. The buffer is almost gone. The Shanghai vaults are at critically low levels and draining fast. COMEX registered silver has been declining for years. London vaults have seen significant drawdowns as metal flows eastward to India and Asia. The cushion is gone. The buffer is depleted. There is no more slack in the system. There is no emergency reserve to tap into when demand spikes. And now, with mints suspending sales and dealers defaulting on deliveries, we are seeing the consequences of years of structural deficits finally catching up to physical reality. The mathematics always win eventually. You cannot consume more than you produce forever. This is not a short-term issue that will resolve itself next week or next month. This is a structural problem that has been building for 5 years and is now accelerating as the crisis becomes self-reinforcing. The shortage creates panic, the panic creates more demand, the demand drains inventory faster, the faster drain confirms the shortage, the cycle feeds on itself. Now let me tell you what I think happens next, because I know you want to understand where this is going. I believe we are entering a new phase of this precious metals bull market, a phase where paper and physical prices completely diverge in ways that have not been seen in modern markets. The paper price may continue to be volatile, it may crash again, it may spike, it will be manipulated and controlled for as long as the paper market continues to function. They have tools, they have leverage, they have access to unlimited paper creation through derivatives, but physical silver will become increasingly scarce regardless of what happens on trading screens. Premiums will continue to rise, availability will continue to decline. Eventually, you simply will not be able to buy physical silver at anywhere near the paper price. The paper price will become an abstract number that has nothing to do with acquiring actual metal. This is already happening. Physical premiums in some regions have exploded beyond anything seen in modern markets. Japan is seeing premiums of 60% over the paper spot price. If the paper price says $95, buyers in Japan are paying $152 for actual metal. Dubai is seeing premiums of 40% over spot. The paper price is becoming a fiction, a number on a screen that bears no relationship to the cost of acquiring physical silver in the real world. This disconnect is only going to get wider as the shortage intensifies. Now, I want to give you some historical perspective because what is happening now has happened before, and understanding history helps us understand the present. In 1979 and 1980, during the last great silver squeeze, similar dynamics played out. Paper and physical markets disconnected completely, dealers ran out of inventory, premiums exploded to unprecedented levels, people could not find silver to buy even as the nominal price was moving higher. The paper market quoted one price. The physical market demanded something completely different. Eventually, the paper price had to catch up to physical reality. It had no choice. When there is no physical metal available to deliver against paper contracts, the paper price becomes meaningless. Silver went from $6 per ounce to $50 per ounce in a matter of months, an 800% increase, one of the greatest commodity moves in recorded history. I am not saying we will see that exact scenario repeat in exactly the same way. Markets are different now. The players are different. The rules are different. There are circuit breakers and position limits that did not exist back then. Central banks are more coordinated. Technology allows faster information flow. But the fundamental dynamic is exactly the same. When physical supply cannot meet physical demand, price must eventually adjust upward to equilibrate the market. That is economics at its most basic level. The paper market can manipulate prices temporarily. It can suppress them. It can create artificial crashes like we witnessed yesterday, but it cannot create physical silver. It cannot mine silver. It cannot manufacture silver atoms out of thin air through financial engineering. Paper manipulation can delay the inevitable price adjustment. It cannot prevent it forever. At some point, physical reality wins. It always does. Throughout all of human history, whenever paper promises have conflicted with physical scarcity has ultimately prevailed. The question is never if, the question is when. And based on what I am seeing with mints shutting down and vaults draining and lease rates exploding and dealers defaulting, I believe we are getting very close to that moment. Now, let me tell you about the industrial demand situation because this is the structural force that makes the current shortage fundamentally different from previous cycles. Silver is not just a monetary metal that people buy for investment. Silver is an industrial necessity that modern civilization cannot function without. Every solar panel requires approximately 20 grams of silver for its electrical contacts. Silver has the highest electrical conductivity of any element. There is no substitute that provides equivalent performance at comparable cost. As the world races to install solar capacity to meet climate commitments and energy independence goals, silver demand from photovoltaics alone is consuming hundreds of millions of ounces annually. China installed more solar capacity last year than the rest of the world combined, and they are accelerating. Europe is racing to reduce dependence on Russian energy. The United States has passed legislation providing massive incentives for solar deployment. Every electric vehicle requires significantly more silver than a traditional internal combustion vehicle. Silver is used in battery management systems, charging infrastructure, electrical connections, and electronic components throughout the vehicle. As the global automotive industry transitions from gasoline to electric propulsion, silver demand multiplies. Every smartphone contains silver, every laptop, every server in every data center, every artificial intelligence chip, processing the algorithms that are transforming every industry. The data centers being built to support artificial intelligence are consuming unprecedented quantities of silver. Silver is everywhere in modern technology, and you cannot build the future without it. The mining industry cannot respond fast enough to meet this demand. Silver is rarely mined as a primary metal. Approximately 70% of silver production comes as a byproduct of mining other metals like copper, lead, zinc, and gold. Silver miners cannot simply increase production in response to higher prices because their production is tied to base metal economics. If copper prices decline and copper mines reduce production, silver supply declines regardless of the silver price. This creates a structural supply constraint that no amount of price increase can quickly resolve. New primary silver mines take a decade or more to develop from discovery to production. The silver needed to power tomorrow's technology cannot be produced tomorrow. It has to come from existing stockpiles, and those stockpiles are nearly depleted. Now, there are three types of people watching this presentation right now. The first type is scared. They see the crash and they panic. They want to sell everything. They want to get out completely. They do not understand what is happening behind the headlines, and fear makes them reactive rather than analytical. The second type is confused. They see conflicting signals. Price is crashing, but mints are closing. The paper says down, but the physical says unavailable. They do not know what to believe. They are paralyzed by uncertainty. The third type understands. They see the paper crash for what it is, a manipulation designed to shake out weak hands. They see the physical shortage for what it is, a structural crisis that cannot be resolved quickly. They recognize this moment as an opportunity rather than a catastrophe. They are using this panic to accumulate while others flee. Which type are you? Your answer to that question will determine your financial outcome from this crisis. Let me leave you with this final thought. The paper price of silver crashed 22% in a single week, one of the most violent moves in recent memory. During that same week, the Perth Mint suspended wholesale sales until late February. The U.S. Mint suspended sales and repriced products 86% higher. The Royal Mint completely ran out of stock. Indian dealers defaulted on deliveries. China drained 27 tons of physical silver from exchange vaults in a single day. Lease rates hit 39%, indicating panic-level shortage. Costco implemented purchase limits. The price went down. The physical metal disappeared. One of these things is a lie, and it is not the empty vaults. It is not the suspended sales. It is not the defaulted deliveries. It is not the exploding lease rates. This is what manipulation looks like when you know how to see it. This is what a disconnect between paper fiction and physical reality looks like when you understand the mechanism. This is what happens when a system built entirely on paper confronts the immutable laws of physical scarcity. They dumped the paper price while the whole world is running out of actual metal, and you get to decide which side of that equation you want to be on. You can believe the screens and sell your metal into the panic. Or you can believe the empty vaults and the suspended mints and the defaulting dealers and the exploding lease rates and hold what you have. The choice belongs to you. But make it with full knowledge of what is actually happening, not based on the magic trick they are performing on trading screens. I will continue to bring you updates as this situation develops. The story is not over. Yesterday may have been one of the most violent trading days in precious metals history, but I believe it is just the beginning of a much larger transformation. The disconnect between paper and physical is now too large to sustain. Something has to give. Either paper prices rise to meet physical reality, or the paper market loses all credibility, and physical markets establish their own pricing mechanism independent of COMEX and the London Fix. Either outcome results in significantly higher prices for physical metal. Either outcome validates those who held through the manipulation. Either outcome punishes those who panicked and sold at the bottom. Remember what I said at the beginning of this presentation. The price is crashing, but you cannot buy the product. That is not a market functioning according to genuine supply and demand. That is a magic trick, a manipulation, an illusion designed to separate you from your wealth. And now you know how the trick works. Now you can see behind the curtain. Now you understand that the paper price has become completely divorced from physical reality. What you do with that understanding is up to you, but do not say you were not warned. Do not say nobody explained what was happening. The evidence is overwhelming for anyone willing to look at it honestly. Mints suspended globally, vaults draining daily, dealers defaulting on paid orders, lease rates at panic levels, physical premiums exploding worldwide. These are not the signs of a market where the price crash is legitimate. These are the signs of a market where the price crash is the last desperate attempt to shake out weak hands before the real move begins. This is the hidden economy. The real story is never on the surface. It is never in the headlines they want you to read. It is never in the analyst quotes they want you to believe. The real story is in the data they hope you never examine. It is in the vault reports and the mint notices and the lease rates and the delivery defaults. The real story is that the paper emperor has no clothes, and the physical market is about to announce that fact to the entire world. Be positioned accordingly. Hold your mettle, understand the game, and do not let them shake you out at the bottom of what I believe will eventually be recognized as one of the greatest buying opportunities in precious metals history. This is William Lee, and I will see you in the next update as this historic situation continues to unfold.